Welcome back to the deep dive. Today, we're getting granular, really looking closely at the Q3 2025 results for, well, a giant in the financial plumbing world. BNY, the Bank of New York Mellon Corporation. They just reported on October 16th.
Yeah, and this wasn't just, another run-of-the-mill quarter. BNY posted some, frankly, eye-popping numbers. So our goal today is really to unpack how they pulled it off. How did they hit a record $5.1 billion in revenue and deliver this massive 25% year-over-year jump in earnings per share, landing at $1.88?
Especially when, like you said, their expenses were actually up too. It seems counterintuitive at first glance.
Exactly, so you have to dig a bit deeper.
And when you do, the big picture seems to be about efficiency. Revenue strong, up 9% year over year. But, and this is key, their non-interest expenses only up 4%. And that gap, that difference, that's really the story here, isn't it?
It absolutely is. That's what creates the positive operating leverage.
Yeah.
And you see it reflected in the profitability. That return on tangible common equity, the ROTCE, hit a really impressive 25.6%.
25.6% ROTCE. That's pretty stellar for a bank of this scale.
It really is. Basically, for you listening, it means they're squeezing a lot more profit out of the equity shareholders have invested in the tangible parts of the business. It's peak efficiency, like you mentioned.
Okay, so let's start with that operating leverage piece, because it feels like the foundation for everything else this quarter.
Yeah, good place to start. It's fundamental. When a firm like BNY, this huge global custodian, grows revenue by 9%, but manages to keep expense growth contained to just 4%, that difference creates, well, significant positive operating leverage. The specific number the sources gave was 493 basis points on a GAAP basis.
Right, 493 basis points. That sounds technical. Can you maybe break that down? Like, what does that feel like for a company this size?
Sure, think of it like this. Imagine a big shipping company. Last year, to ship $109 million worth of goods, instead of $100 million, maybe it'd cost them an extra $5 million in operational costs, fuel, labor, whatever. Now, imagine they've gotten smarter. They've optimized routes, automated things. This year, they shipped that same $109 million worth of goods, but it only cost them an extra $4 million. That extra $1 million they didn't spend, it just falls straight to profit.
Ah, okay. So BNY found ways to grow without growing their costs proportionally. They kept that extra slice.
Exactly. And for a company with, tens of thousands of employees, massive IT infrastructure, finding those savings, that compression, that's what drives their pre-tax margin up to 36%. They're effectively holding costs steadier while the revenue engine picks up speed.
And this wasn't just luck, right? The CEO's comments seem to tie this directly to specific strategies.
Oh, absolutely not luck. It's execution.
Yeah.
Management was very clear, pointing to two main transformation programs. First, something they call the new commercial model.
What does that involve?
Basically about driving more sales and focusing on multi-product solutioning. So instead of just selling one service, like custody, they aim to sell a whole bundle. Custody plus asset servicing plus maybe collateral management, all packaged together for big clients.
Makes sense. Deeper relationships, more value. And the second program, that must be about the cost side.
That's right. That's the platform's operating model. This is the nuts and bolts of streamlining their tech and operations, getting rid of old, clunky legacy systems, moving on to unified modern platforms. And the key phrase management used was that the benefits are now starting to materialize.
Meaning they're actually seeing it in the numbers now. The savings are real.
Correct. They're seeing that expense line react as they make these shifts. And interestingly, technology, especially AI, seems to be a big part of this.
Yeah, the sources mentioned an internal AI platform, Eliza.
That's the one, Eliza. They just rolled out a new version to all employees last month, described as smarter, faster, and easier to use. Now, think about BNY's business processing trillions in assets, countless transactions.
AI could automate a ton of that back office stuff, right? Compliance checks, data reconciliation.
Precisely. The kind of stuff that normally eats up manpower and drives up non-interest expense. So investing a bit more in tech, like Eliza, probably helps them save much more on older systems or manual processes. That's how you get that 4% expense growth figure, even with new investments.
Okay, that connects the dots on the efficiency story. Let's pivot now to where the actual money, the revenue, is coming from. Section 2 in the outline talks about net interest income, NII. That looked like a major boost.
Huge boost. NII was up 18% year over year, came in at nearly $1.24 billion. That's a significant chunk of their total revenue.
Why such a big jump? Is it just higher interest rates helping them out like other banks?
Well, yes and no. They benefit from higher rates, definitely. But for a custody bank like BNY, The mechanism is a bit different. The sources explained it's mainly about reinvesting their portfolio. Yeah, they hold a lot of cash and securities on their balance sheet as part of their operations.
No.
As older, lower-yielding bonds and investments mature, they're replacing them with new ones that lock in today's higher interest rates. It's this constant cycling and reinvestment at better yields that's driving that NII number up.
So it's not just about loan margins, it's about managing their own massive pool of assets in a rising rate environment. And that suggests it could stick around for a bit until rates fall significantly.
Exactly. It's a persistent tailwind for now. And this whole dynamic pushed their net interest margin, or NIM, up by 15 basis points compared to last year, reaching 1.31%.
And crucially, their funding source, their deposits, held up.
Rock solid. Average total deposits were around $299 billion. Pretty much flat compared to the previous quarter, which is good stability, and still up 5% from a year ago. Stable, relatively low-cost deposits are key to making that NII engine really hum.
Okay, good context on NII. Let's move into the core business units then. Section 3 gets into the segments actually generating that $5.1 billion in revenue, starting at the big one, Securities Services.
Right, Securities Services. This is BNY's bread and butter, the custody and asset servicing powerhouse. And it performed really well. Total revenue up 11% year over year.
And the profit?
Even better, thanks to that operating leverage we talked about. Income before taxes for Securities Services jumped 26% year over year.
Wow. It really shows the scale advantage. What's the key metric that shows just how dominant they are here?
It's the AUCA assets under custody and data administration. That number grew 11% year over year, too. And it reached, wait for it, $41.7 trillion.
$41.7 trillion. It's just hard to even comprehend that scale.
It really is. You have to pause on that. They are essentially the plumbing, the core infrastructure for a huge chunk of the global financial system. Pension funds, giant asset managers, sovereign wealth funds, you name it.
Almost impossible to replicate that kind of trust and infrastructure. So what drove the actual 11% revenue growth within that massive segment?
It seemed pretty broad-based. Asset servicing revenue was up 12%. That reflects, higher client activity generally, but also just higher market values. When asset prices go up, their fees often go up too.
Makes sense.
And issuer services, which handles things like depositary receipts for companies, that was up 10%, mainly due to higher fees in that area. So healthy activity across the board.
Okay, next up, Market and Wealth Services, or MWS. This one also looks strong, particularly on the margin front.
Yeah, MWS had great top-line growth, revenue up 14% year over year. But the number that really jumps out, especially for you trying to understand their efficiency, is the pre-tax operating margin, 50%.
50% margin. So half of every revenue dollar in that segment is pre-tax profit.
Basically, yes. It's incredibly profitable. It suggests these are highly scalable businesses, likely built on tech platforms where adding more volume doesn't proportionally increase costs.
Incredible. What were the main drivers within MWS?
Well, investment services fees were up a solid 9%. But again, like NII, this segment really benefited from market conditions. Net interest income within MWS soared 26% year over year. And get this, their foreign exchange revenue leaped 35%.
35%. Wow. So when markets are volatile or active globally, they really cash in as the facilitator.
Absolutely. They sit in the middle of so many transactions. And the subsegments confirm this. Clearance and collateral management revenue was up 12%. The sources said this reflects higher collateral balances, more clients using them to backstop trades. And Treasury Services revenue grew 7%, which they attributed to winning net new business. So they're taking share or just getting more business from existing corporate clients.
Okay, so Securities Services and MWS are firing on all cylinders. Now we get to Section 4, the part that needs a bit more explanation, investment and wealth management. Because the headline number there looked different, right? Revenue is down.
That's right. This is the one segment where total revenue actually declined 3% year over year, which, in the context of a record overall quarter, definitely stands out. Looks like a potential weak spot.
But the profit picture was different.
Exactly. And this is where that efficiency story comes back in, but in a defensive way. Despite the revenue dip, income before taxes for investment and wealth management was actually up 5% year over year.
How? They must have really cut costs.
They did. Non-interest expense in this specific segment was cut by 5% year over year. Those efficiency savings more than offset the dip in revenue, protecting the bottom line.
Okay, cost control saved the day there. But why did revenue dip in the first place? Markets were generally okay, weren't they? This is the nuance you mentioned.
Yeah, this is really important context for you listening. It's mostly down to an accounting change. Starting in the first quarter of this year, 2025, BNY changed how they account for certain client rebates. Yeah, think discounts or fee adjustments they give back to some clients. These rebates, about $20 million a quarter, according to the sources, used to be booked as an expense.
Okay, so they showed up on the cost side of the ledger.
Correct. Made expenses look higher. Now, under the new accounting rule, these same rebates are treated as a reduction of investment management fees, meaning they lower the reported revenue number instead.
Ah, so that 3% revenue decline isn't necessarily lost business. It's largely just reclassifying about $20 million that used to be an expense. Now it reduces the revenue figure.
You got it. It's a technical shift. That $20 million adjustment significantly impacts that negative 3% headline number. The underlying performance was likely much better, maybe flat, or even slightly up if you adjust for that change.
That is critical context. Without knowing that, you draw a completely wrong conclusion about that segment's health.
Absolutely. And looking at the assets themselves, assets under management, AUM, were basically flat compared to last year, around $2.1 trillion. Market gains were offset by some net outflows over time. But interestingly, their wealth management side, focusing on high net worth clients, looks strong. Client assets there were up 5% year over year to $348 billion.
Suggests they're holding on to and growing that core wealthy client base. Okay, that clarifies the investment management picture. Let's wrap up with Section 5, capital and shareholder returns. They seem pretty solid there.
Very solid. Regulatory capital ratios are strong. Their CET1 ratio, that's Common Equity Tier 1, is at 11.7%, comfortably above requirements, and it even ticked up slightly from the previous quarter. Tier 1 leverage ratio also healthy at 6.1%.
And strong capital usually means returning cash to shareholders, right?
Typically, yes. And BNY leaned into that this quarter. They called it attractive capital returns. In Q3 alone, they returned $1.2 billion to common shareholders.
How did that break down?
It was about $381 million in dividends, the regular payout, plus a pretty hefty $849 million spent on share repurchases, buying back their own stock.
That level of buyback usually signals management thinks the stock is a good value.
It certainly suggests confidence. And if you look year to date, it adds up. Their total payout ratio so far this year hit 92%. They're clearly prioritizing getting cash back to shareholders, and their tangible book value per share is sitting at $30.60.
Okay, so summing it all up, it feels like BNY really executed this quarter. Strong bottom line growth, driven not just by riding the wave of higher rates for NII or their sheer scale in Securities Services, but very deliberately through those efficiency gains. Managing costs seems just as important as growing revenue for them right now.
That's the core narrative, I think. BNY is proving it can execute on this transformation strategy. They explicitly linked tech investments, things like that ELIZA AI platform and the move to the platform's operating model, to controlling expenses, and achieving that 493 basis points of positive operating leverage. That's not trivial. That's the engine behind turning a good quarter into a record one.
Which does leave us with a final thought, something for you, the listener, to chew on. We've seen how critical these efficiency gains, driven by AI and platform changes, were this quarter. They allowed costs to grow much slower than revenue, creating that powerful leverage. The question is, how much more juice can they squeeze from that lemon?
Right. Is there a limit to how much efficiency they can wring out through cost control and tech optimization? Or can this continue? At some point, does future profit growth have to rely more heavily on just pure, significant revenue expansion in their core businesses?
Exactly. Is this efficiency drive a story with many more chapters, or are we nearing peak optimization on the cost side? That feels like the key question hanging over BNY as we look ahead.